All right, so let me get started. This is the Avatar version 6 tutorial or introduction to Avatar version 6. So I am going to run through all of from the very bottom to the top of Avatar strategy, all the ins and outs, everything you need to know to use this strategy to catch some pips in the market on a daily basis. So the Avatar strategy, just to give a brief intro, is a compilation of a couple of strategies that I've learned over the past year and a half since I started trading, and kind of blended it all together to make something that I've found to be very helpful, very useful, and very effective. And I've seen in recent days how this strategy has been helping my inner circle do great things in the market. So um, let's get started. And first thing I'm going to do is go through the indicators that are on the chart. One of the things that I tried to do with this strategy is keep the chart as clean as possible. And it's kind of hard when you have multiple indicators, but here we go. So we're going to start with the PSAR dots. These are your reversal indicators, shows you when the trend is changing. The sessions indicator just shows you the time of day. You can customize them based on what time you are likely wanting to trade. And you can also change the colors if you want to. These are the default colors. I like it set like this because I see the New York, London overlap here, and then the red section tells me, okay, it's almost time to stop trading. Now, but this is optional. You don't have to put that on the screen. I kind of like to see the sections of the day on the chart. And then your Heikin-Ashi candle color alerts. This indicator is used to show when the candle changes color, and it's a pretty good exit indicator. And so you can use that for when you're in a strong trend run, and when you see that candle color change, it'll send you an alert and tell you, hey, time to get out that trade. It is over, it's a wrap. And you move on to your next entry. And this is what it looks like when you put it on the screen. It kind of just indicates the direction of the candles at that point in time. But you can hide that. It doesn't necessarily need to be on the screen unless you want it there. The next indicators are the smooth moving averages, the price action channel. You have this channel here. These are the 20 smooth moving average high and 20 smooth moving average low. And you can also add the 20 close as well if you want to. I choose not to. I think it looks cleaner with the middle of the channel open. But if you want to add the middle of the channel, you can do that as well, whatever your preference is. So looking at now, next one is I added a shift or a 5 and 13 EMA cross indicator here where it prints arrows wherever the shift is happening. So you can use that as an additional confirmation for your entries. Typically, if you see a flat bottom candle on the Heikin-Ashi with a shift as well happening at the same time, that's typically going to be a nice entry. And the Heikin-Ashi candles are pretty much the backbone of this strategy. The reason that I like using them is because it filters out the noise of the up and down of the regular candles and kind of helps manage anxiety and stuff like that when you're in an active trade, when you're in profit or whatever. And it's just easier to look at, to see the trend. It shows you the trend of the market at a glance, and it doesn't change colors. The candles don't change colors back and forth as often as the regular Japanese candles. So next we have, and the biggest addition to the strategy, well, the two biggest, but we have the TDI is a normal part, but then we have order blocks. So added ordered blocks to enhance the setups, to add a different layer to this, a new layer to the strategy as well. And order blocks are basically where the big banks and the big institutional traders are placing big orders to cause really big moves in the market. So we have an indicator here that will show you where the order blocks are, and we have two of them. One is for the lower time frame, which is anything less than the 1 hour time frame, and one for the higher time frame, this one here. This one is off for the lower time frame so that you can only see the order blocks that are relevant to this time frame or to the lower time frames. Because the settings are a bit different, and I set them so that it shows you the useful order blocks and not every single one. And the settings are different for the higher time frames. So these two are not the same, so don't see two and then delete one. These are they're different. So you need both. And then your TDI, again, it's if you don't know TDI, you should watch some YouTube videos on how to read it, how to use it. But the TDI shows you volatility and direction of the market. So these are your indicators for the avatar strategy. And let's get into the rules now. So let's go over our little cheat sheet right here. So when you're looking for entry confirmations, these are what you want to look for. You want to look for a flat candle, whether it's a flat bottom for buys or a flat top for sells. And then you want to see that PSR dot flip to the flat side of the candle. The more distance between the PSR dot and the flat side of the candle, the stronger the move in that direction. So that's something to keep in mind. And as well, if you see a W, you want to look for W and M's and W formations on the chart. So if you see the candles making an M formation, and as well on the TDI, you see an M formation, kind of like right here, you see that up, down on the TDI as well as on the candles. That's typically a nice indication for a sell. And you see here right after the M, you got a sell signal on your TDI, and your RSI is crossing your liquid 50, showing that shift in momentum to the downside. So that's your TDI shift confirmation there. And so these first three are for trend trades. The VBC plus TSI cross is for reversals. So let's just say you see a really strong push to the upside and you want to catch that reversal on the way down, but you don't want to wait for the shift because the EMAs are all spread out, and you don't want to wait till it gets halfway down and then get in for a sell and it turns around on you. So what I like to do is when I see a strong push like this, where you see like a long shark fin, and then you see a VBC where the RSI is crossing the outer band and the TSI at the same time, that is typically a nice place to get in for a sell. And you're going to get a pullback before the actual drop, but that is usually a nice place to get in for a reversal after a strong push. But again, unless you see an M formation, that is a bit of a risky play because you're likely going to be playing counter trend. But that is how you identify nice entries for reversals. And then the channel. So we use a channel to identify the short-term trend. So this 20 EMA channel here, and everywhere below the channel, we're looking for sells, and every buy entry is a pullback until it crosses the channel. And then once we're above the channel, every sell entry is a pullback until it crosses the channel. So here you'd be nothing but buys. This is a pullback, this is a pullback, buy. This is a pullback, buy. This is a pullback, buy. So the channel is kind of what kind of helps to identify direction, and it also is a nice place for re-entries. If you miss an entry for a buy, it's a strong trend run, and you're like, man, I missed it, but I don't want to chase, and then it pulls back on me. you wait for it to pull back to the channel and start rejecting, and then you take the next entry after it rejects off of the top of the channel. So like if I miss this buy up, I wait for it to pull back, and then I wait for this entry confirmation here, where I got my flat bottom, my PSR dot, and I take that buy up. And then you could even if you caught this buy, let's just say you're holding this for a long term, you could scale in and add another entry when it pulls back here, and double up on your profits. But that's dependent on the type of trader you are. If you're confident in your entry and you know it's going to go up more, you could wait for it to pull back and enter again and add to your position. Every time it pulls back to the channel, add another. So that would have been 1 entry, 2 entries, 3 entries, and you'd be in triple profit right now. So that is how we use the channel. So let's go and look for some entries right now, just so you can see how it is to trade with the avatar strategy. So it's pretty simple. I tried to make it as easy as possible, as simple as possible. And so let's so right here, you see you have a flat top candle and your PSR flip to the top, to the flat side of the candle. And your entry would be here. And your stop loss always goes outside of your PSR dot, is the safest place for it to go. And you get out, you can either follow your TDI exit or you can follow the candle exit. So on this doji, you'd be out, right? So this didn't go for a huge amount of pips. However, it went into profit, and you see an exit right here. So you could have gotten out right here on this VBC. And if you gotten out on this candle, you'd have probably gotten out at break even. Or if you got out at the bottom of this candle here on the ESC 40 exit, then you'd be out. And you would have gotten a little, 150 pips, not bad, right? But the thing about this is, even if you get out at break even, 2 candles later, 3 candles later, you got another entry for a sell again. So even if you get taken out at break even, you can get in on this next candle right here because it gives you another entry right here, and then you catch the real move. So pretty much you get in, set your stop loss above the PSR dot, and you get at least a 1-to-1 out of this. Right now, you might say, "Hey, we got doji candles in here. What is that?" You can get out based on the TDI exits. You can get out at the bottom of this candle, or you can trust your trade and wait for it to go and give you another exit, which in here would be the TSI crossing back up, or the LC on the TDI. Then you get out. Or you can just take partials when you see these dojis. If you're confident that your entry is solid and it's going to continue, you just take partials whenever you see a checkpoint. So you can use, if you're in a trend run, you can use dojis as a checkpoint or an exit, whichever you choose. For me, I like to take 500 pips and get out the market. So I would have set my TP for 500 pips right here, and I would have just let my TP get hit. But if you want to maximize your profits, you hold for your exit. So that is pretty much how you take entries. And another thing, so we don't try to predict the market when we're trading with the strategy. We just react, right? So you have multiple opportunities to get into the trade throughout a trend run. Even for reversals or pullbacks, you can trade pullbacks. Just like, for example, here, you see this trend run ended here and it LC, meaning the momentum shifted to the upside. And you have another entry for a buy here. You can take this buy once you have your confirmation. So you have multiple confirmations here for a buy, which is your flat bottom candle, PSR flip to the upside, to the bottom of the candle, as well as you see a W formation on your TDI, your RSI is shifting on the crossing the liquid 50, as well as your liquid 50 is very, very low. It's down at the 30, close to the 30. So you can expect that price is going to potentially push up from when the liquid 50 is that far down. So if you had taken this buy, you would have set your TP right here below the PSR dot, and you would have gotten a 1 to 1.6, 1.7. Now, if you had gotten in on, actually, this is where you would have gotten in because this candle is a flat candle here. So you actually would have gotten like a 1-3 risk to reward if you held it all the way to the peak here and got out. So one thing that I've noticed is that you can get at least 500 pips or a 1-to-1 out of this strategy when you if you take a good entry. You're going to get at least 500 pips on indices. For regular pairs, if you're using this from Forex, you're going to get at least 20, 30 pips out of a good entry. So now let's talk about exits, right? So we kind of talked about it a little bit, but let's go back to our cheat sheet here. So our exits are the doji candle. So we're talking about a really, so you're talking about a really skinny candle with a, how do I do this? Skinny candle with a wick on both sides, something like that. I could do better than that. That's terrible. Skinny candle with a wick on both sides like that. That's a doji candle, and that is you want to get out. You can get out if you're scalping and you want to get out on a doji. Sometimes on trend runs, you get dojis in between. You can hold through them and use a different exit, whether it's a PSR flip or something else on or TDI exit. Those will keep you in the trade longer. So that's a doji candle exit. Your TSI cross, if you're in a trend run and you see the RSI cross over the TSI in the opposite direction, that's a checkpoint. You can use that to take partials, or you can get out, just get out the trade and take your pips. And then the PSR dot flip, definitely if the candles push in the opposite direction and flip the PSR dot, you are either going to get taken out because you're trailing your stop with the PSR dot, or you just need to get out the trade if you're not trailing your stop. Just take whatever you get at that point and get out. And then if we are trading the channel, let's go back to the candles. If you are in a buy and the candles are above the channel, if those candles pull back into the channel and close solid inside of the channel, exit the trade. So you see on these pullbacks here, it pulled back, it touched and bounced off the top of the channel, but it never closed solid inside the channel. So you stay in the trade. That's just a pullback and it's correcting and then continuing. So like for this sell here, you had a nice sell, and then price turned around and came back and closed solid inside the channel. That if you're still in whatever portion of your position that you still have riding out, that at that point you just close it out because it's likely gonna, play around, either consolidate or it's gonna reverse on. So let's talk about, and one of the good things too is if you're in a strong trend run, you might not want to sit and watch the trade for like 2 hours because this is the 5-minute time frame. So if we look at how long this trend run took, this was 5-6 hours, right? So you don't necessarily want to sit and look at your chart for 6 hours while you're in this trade. So what you do, you come in here, you can actually count your color charts and you set your alert. So if you're in an uptrend, you want to know when a down candle forms. right? So either you can take partials or you can exit the trade. And then you do once per bar close, because we don't click while the candle is moving. We wait till the close of the candle. And then if it's a sell, then you want to know when it's an up candle. But in this case, for a buy, you want to know when a down candle forms. And then you label it whatever you want to, NAS, 5-minute, down candle, exit, whatever, create, and then you just walk away. And when it'll probably give you, an alert here, it'll give you one here. It actually is going to give you one for every down candle. So even if you miss it the first time, each one of these candles is going to alert you so that you can decide whether or not you want to get out of the trade or hold, or take partials, whatever you want to do, or trail your stop a little bit tighter. So that is the first new, well, not new, but the first tip that I wanted to share. And then also, so we got the entries and exits now. So let's talk about these order blocks, right? So what are order blocks? Now let's find a clean section of the chart. So basically, really simply, if you watched the video in the chat, great. If not, I'll just explain it real quick. And an order block is pretty much a level on the chart or an area on the chart where the big banks place their orders to activate, right? So the big banks, the institutional traders, the billionaires and whales, they place orders on the charts. And whenever they do, you see a big move in one direction. So like right here, this is a big momentum shift, a big trend run. That was because of this order block here. So basically an order block is the very last down candle before a rally. And in the opposite direction, an order block is the last up candle before a drop. So you can mark these manually, which is what I did right here. I draw through this rectangle. This is an order block right here, right? It's a small one because this is the 5-minute time frame. But you can see after this candle, price pushed up really heavily, right? It pushed and it went for, I don't know how many pips is that. It went for 1,300 pips, right? So you might come on the chart here and say, man, I missed the move. Oh man, I want to, I'm sad, I'm pissed off, I missed it. What you do is you can say, okay, look, I see an order block right here. If price comes back to this zone, then I'm buying, because these buyers here don't want their investment to go south, to go red. So what you can do is you can either wait for it, watch it, and wait for price to come in here and then click for a buy and just ride this wave up. Or you can set a pending order at the top of this order block and put your stop loss beneath the lowest wick in this vicinity. So you put your stop loss right down here, like this, to a long position. Set your pending up like this, long position right there. And then your stop loss goes below the lowest wick. And you set your 1 to 2 or whatever you want, whatever you think you're going to get. And what happens is price boomerangs and comes back to that spot, and then it rejects really quickly. Why? Because this is what we call a liquidity grab, right? Because all of the buyers that bought off of this movement, their stop losses are in this zone because they're likely trailing their stops as price moves up in the profit, right? So the smart traders have their, once it gets, into profit, they have their stop loss below structure. So right here is a little structure area. They have their stops here, or they are trailing their stop with every candle. So the pullback is to take them out. And, they had a liquidity grab here where they pushed down real quick to hit everybody's stop who was here. So like pullback, if you held through the pullback and you see it starting to go back up, you might put your stop here. They pulled back, hit all those stops, and then pushed up again. Right here, they did the same thing. They pushed up, and there's a lot of buyers in the market now. So what do? They pull all the way back, flush the market, hit all these stops, activate these pending orders down here, and then they pull away really quickly. So you can either try to, if your click speed is really fast, you can try to click as they push down here and ride that impulse back up, or set a pending order and, with modest leverage, just in case they push through and hit your stop. And you can see that'll be some of the fastest profits you'll ever see, because when they come down here, they don't want to give people a chance to get in for a buy. They're trying to just sweep the stop losses and continue on their way. So what they did here, they pulled back, hit the order block, bounced up, and then came back, broke through the order block, and then continued. So this was around opening bell time, so not the best time to do this because it's really, really fast. But in general, these order blocks work, and this is the reason why. I'll show you why. Let's see. Let's find one. So let's go this. Okay, so this is a nice one right here. So this is an order block right here. Last up candle before a big push down, right? Big push down. So you mark that. If you miss the drop, what you can do, mark your order block, which is the full length of the candle, right? And what you can do, just wait for it to come back up, set a pending order here, or even if it comes close to it, and you take that sell right up here and ride the wave back down. Now, it's not going to work every single time, but this is a pretty effective way to get in, to get the best entry for a sell, because you get in before the sell even starts. But you are able to do that because you know that this order block is really strong based on how many pips the market moved after this order block was formed, right? So other thing you can do is you miss the sell, look for confirmations for a buy and take the buy down here and set this order block as your TP. So what you can do is you see your W formation on the candles, W on the chart, TDI squeeze plus TDI shift, and your flat bottom candle with your PSAR dot flipping here. And then you also have your shift candle 2 candles later. So you can get in right here, place your stop loss beneath the PSAR dot, and set your TP, 1 to 2 risk to reward ratio. Set your TP to the bottom of this order block, and it's pretty spot on. And you can do both. You can actually take the buy up and set a pending order here and ride the wave down. So once your TP gets hit, your pending gets activated and you collect all these profits without having to worry. And one of the things that I forgot to mention is that when you are in a trade, how to trail your stop loss. So I always used to trail my stop way too close and get hit and then they continue. So let's just say you're in this trade. Trailing your stop loss is pretty simple with this strategy. If you are in this trade, you put your stop beneath the PSAR dot. And what I do is the safest way to trail your stop is to trail it with the PSAR dot, right? Every time a candle opens and the PSAR dot moves, you move it up, 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 right? That's the conservative trailing stop loss. The aggressive stop loss trail is you trail your stop loss with the previous flat bottom candle if you're in a buy. So let's just say I'm in this buy. Every time a flat bottom candle forms, I'm putting my stop right beneath it, putting my stop right beneath it, until they take me out. That's the very aggressive stop loss trailing. So once you're deep in profit, that's what I recommend, is to put your stop loss right beneath the flat bottom candle and just wait for them to let them take you out, or you follow your exit and close manually if your TP doesn't get hit. But that's how you trail your stop loss, and I think it is a pretty effective way. Also, if you're, like in this case, your stop loss is really big compared to the is really big in this case. So what you can do is use the channel as your stop loss. So you can put your stop loss on the opposite side of the channel if you're outside of the channel when you're entering. Shout out to Reggie for coming up with that idea. It's pretty cool, it's pretty smart, because I've seen how that can really work. And it also can reduce your stop loss, which means you can take a bigger lot size and still have the same risk. So that's a pretty useful place to put your stop loss starting out. So in this case, you almost got a 1 to 2 risk to reward ratio rather than putting your stop loss down here. Now, it's closer, stop loss is smaller, so in a high volatility time, it might get hit if you put it here. But again, you're managing risk on every trade, so it doesn't really matter. But you can maximize your profit if you have a smaller stop loss. So it all depends. You gotta, make that choice based on the time of day and the current market conditions. So let's look for another setup here with some order blocks. So I want to show an order block that gets mitigated. And what mitigated means is that the order block is formed and then price comes back to that same area and then rejects and continues with the trend direction. So let's see. And this is on the 5-minute time frame. So the higher the time frame, the stronger the rejection is going to be off of that zone. So this is just on the 5-minute time frame, and you see the effectiveness of order blocks. Imagine a 1-hour order block or a 4-hour. Your rejection off of that zone is going to be crazy. So let's look at this. Okay, yeah, this is good. So let's do this. This is an order block right here. It's a small one. It's not a huge, but it counts, right? So if we mark that order block, look at what happened. Price came back to it here, pushed up, came back here, pushed up again. It came back here, and then it pushed up majorly, right? So this order block was mitigated by these wicks right here. So you can, again, every time it came back to this area, price rejected and went up. So you can literally set pending orders at the top of this and put your stop loss on the other side of this order block. And you can pretty much be confident that you're gonna catch pips off of that order. Okay, so this is on the 5-minute time frame. So now these two indicators here mark the order blocks on the chart based on the settings. I have them set so that one is for the higher time frame and one is for the lower time frame. And you don't, so only this one is going to show up on the lower time frame, anything less than the 1 hour. Everything up 1 hour and up is going to show these order blocks here because the settings are different. You want to kind of filter out the non-important order blocks and kind of show you just the strong ones, the major ones. So you can use these order blocks for entries and targets and exits. So that is pretty much what order blocks are and how they work. Let's go to the 1 hour time frame just so you can see how it looks on a higher time frame. So this is the 1 hour. Did I turned it on? So see, I marked the order block here, and it matches up with a 1 hour order block. So pushed up, came back to that same 1 hour order block and mitigated this one, and then it pushed up heavily. So that's one example. And if you see here, this is another order block that I marked, and also it coincided with them. This was on the 5 minute, but it coincided with the 1 hour order block. And yeah, price likes to come back to these and then reject. So sometimes it'll come close, but it won't come all the way into it. So if you're setting pendings, I like to set my pending like a little bit above the order block so it can get picked up if it doesn't go all the way in. But you can also watch it and just click for the buy once you see it gets close. And just under leverage or be modest with your lot size in case it doesn't play out the way you expected. But that is pretty much it. Oh, somebody was asking when I said that DeLoreans are order blocks. Somebody was like, "How? Don't understand." So let me change the candles real quick, and then let me switch up my indicators, and you will see how DeLoreans are order blocks. So if you look at this, so if you look here, this is the 1 hour time frame, and if you mark this as an order block, the short candle on this DeLorean, look what happened when price pulled back up and wicked that area. It dropped back down, retested the aqua, and then it dropped some more, right? It never came back up here. So order blocks don't have to be at peaks and valleys. The strongest ones are going to be at the peaks and valleys, but there are order blocks in between the highest and lowest points of the market as well. So for example, this is an order block right here, right? Because this is the last up candle before a push down, which is basically what a DeLorean is, right? It's you have a push up, a fake out, and then a big drop. Push up and then a big drop. So every time price comes back to one of these areas like this, it drops. And it does the opposite in reverse too. So like right here, this is an order block, small one, but this is on the 1 hour time frame. So if I mark that order block, look what happened when price started to drop and reach to this zone. It touched the top of that order block barely, and then it took off again. And you can tell when an order block, when a price hits an order block, because again, it comes down, hits it, and it rejects instantly. It doesn't stay in this area, because what they're doing is they're grabbing liquidity that's in the market, and then they're continuing in the direction that they were going to go in all along. So that is how order blocks are used. So let's go back to the avatar setup. Oh, and by the way, if you want to save your indicator as a template, what you do is you click on these 4 blocks right here, say indicator templates, and then you can click save indicator template and name it. So then you could take a blank chart, or you can switch back and forth between sets of indicators without having to switch layout. So like right now I could change to regular candles and my matrix ELO setup with the EMAs and all that. And I can switch right back to the avatar in one click instead of having to switch layouts. But what you want to do though is I have my auto save turned off. So because you don't want to save different indicators under your avatar layout. So just turn off the auto save, and whenever you want to save stuff, you just click here on the layout. So that is the avatar version 6. Let me just show you guys how even on the higher time frames, the avatar strategy is legit. Let's go back to Hikinashi candles. So this is a 4-hour. I don't trade on the 4-hour. I look at the 4-hour just to kind of try to figure out overall direction. But the effectiveness of this strategy on the higher time frame is unbelievable. If you look here, you have, first of all, you see these order blocks here, right? So you see this order block. You can literally see every time it comes back to it, it push down, come back, push, come down, push, come down, push. So right here now, we got a flat top candle, PSR dot flip, and now we're below the channel. That is a perfect, perfect, perfect entry for a sell. Now, higher time frame, your stop loss is going to be huge, right? That's almost 1,000 pips, right? But look at your payout if you held this trade to TP. 2,000 pips. Or is that 20,000? It's 20,000 pips. Sorry about that. This is 9,000 pips stop loss, 20,000 pip TP. If you held for this, this is like a week and a half. But get your payout, 20,000 pips, even on a 0.01, that's $2,000. Right? So, I mean, if you're a swing trader, you can use this. Wait for price to cross that channel. Look for your confirmations. We got a TDI squeeze in the middle, RSI pushing outside of the bands, flat top candle, PSR flip, and you hold for your exit. Turn on that Hikinashi candle color change on the 4-hour, and you wait for it to alert you, and you hopefully you're not sleeping when you get the alert and you get out. But swing traders, if you like swing trading, this is easy money. I mean, and you can literally for this time frame, you can expect to get at least 1,000 pips out of every good entry. Now, if you take a bad entry like this one, you know, then you're gonna get your stop hit unless you get out before. But if you now that we have order blocks, it can help filter out these bad entries, because you're gonna see there's a big order block right here. This is just retesting that order block before it buys up. So I should just buy or wait for a buy entry, since it's pushing down into this order block. Pretty much that is avatar strategy for swing traders. It works on every time frame. Yeah, any questions?
I don't see the order block on the higher time frame.
Shawanda, if you're talking, I can't hear you. Not sure what's going on.
Can you hear me now?